right, why do we talk about the banks so much? Because that is where the money is. And today, it's also where some money is being made. JP Morgan Chase, Citigroup, Wells Fargo beating on most major metrics. But we get more big money banks next week. Bank of America, Goldman Sachs, Morgan Stanley. Will they be as good? And which stocks should you look to invest in now? Ken Leon from CFRA joining us now. Ken, welcome. My debt and deficit snark aside, you must be very happy with the JP Morgan Chase numbers.
Well, especially JP Morgan, it's great to be with you, Brian. And the reason is, first as an investor, then I'll be the bank analyst. We probably will have a rate cuts from the Fed in the second half of next year. And talking to Sam Stovall, my chief investment strategist, financials tend to do well 9 months before. JP Morgan Chase is one of the top 3 constituents, not only of banks, but the entire financial sector. So I'm very pleased with JP Morgan Chase. I think Wells Fargo and Citigroup, they're both story-driven, company bank story-driven, and of course they have more room to improve. But JP Morgan's going to be most important as we look ahead, particularly eventually the Fed's going to cut rates.
When would that happen? You just heard us talk about the spike in interest rates. I know they're not directly related. One, we're talking about bond yields. Now you're talking about the Fed funds rate, Ken. But, you know, the bond market will move on that. So when do you think that could happen? 2024?
So, prior to today or this week, certainly the bar has moved to the second half of next year. The consensus from economists was probably the first quarter going several months ago. The likelihood, though, is when we look back all the way to 1946, when you make that change to rate cuts, we're not going to have a rate pause forever, whether it's precipitated by recession or something. But when you do have that rate cut, financials and banks do well. And that's what portfolio managers are thinking about. When we get into the fundamentals of banks, the economy's good, consumers still strong, the credit loan loss reserves are stable, but there's other worries related to tighter regulation, increased capital reserves, and whether they get pinched in terms of how much they can return capital, such as buybacks or dividends.
I don't think you could, correct me if I'm wrong, I don't think you cover, I'm just a fill-in anchor today anyway, Ken. I don't think you cover the regional banks, looking at your coverage list, maybe some of the super regionals. You heard our conversation just now, though. Could we learn more maybe about the economy from a super regional like a Key or a PNC than a Bank of America or a Goldman Sachs?
Sure, and I can address the regional banks from the standpoint that first with the consumer, you're probably going a little bit downstream away from the best credit score, FICO scores, that JP Morgan enjoys. And additionally, they're not diversified, so they don't have a global footprint for business or for loans or the capital markets, trading, and investment banking. So it puts a lot more pressure in terms of that real estate portfolio, where for the largest banks, they're mostly secured investment grade types of borrowers. I think the concern also, going back to the bank crisis we had in March, is deposit risk, because there is a shift from non-interest bearing to interest-bearing deposits, which sometimes may leave the smaller banks. So that is a concern.